2026 is here, and America is entering what experts are calling the Great Housing Reset. Forget everything you knew about the pandemic housing boom. This year, the rules are completely different. Mortgage rates are stuck above 6%, home prices are plateauing, and the market is finally shifting from frenzy to normal. But is normal good or bad for your wallet? Whether you're a first-time buyer who's been priced out for years, an investor looking for your next opportunity, or a homeowner wondering if now is the time to sell, this video breaks down exactly what's happening in the USA property market in 2026. Backed by real data from Zillow, Redfin, and top economists. I'm here to dive into the numbers that matter. First, let's talk about why 2026 is different. The US economy is entering what RBC Economics calls stagflation light. Basically, slow growth with inflation that just won't go away. This has huge implications for housing. The GDP growth is expected to be just 1.8% for 2026, which is below the typical trend. Meanwhile, Morgan Stanley forecasts global growth moderating to 3.2%. As for inflation, the core inflation is predicted to stay above 3% for most of the year. That 2% target the Fed has been aiming for. It's still out of reach, with the core PCE index forecasted at 2.6% by the end of the year. This brings us to interest rates. While we do expect the Fed to continue rate cuts through April, the target rate is projected to land between 3 and 3.25% by mid-year. We also have a Fed chair transition coming up in the second quarter. The overall policy is expected to stay consistent. And what about jobs? The job market is cooling down significantly. Unemployment is expected to peak at 4.5% in early 2026. We're seeing job growth slow. And the labor force is actually shrinking due to an aging population and stricter immigration policies. So what does all this economic talk mean for housing? In a word, everything. This brings us to the main event, the Great Housing Reset. Redfin just coined this perfect term. This isn't a crash, it's not a boom. 2. It's a complete recalibration of the market after years of pandemic chaos. Let's look at the numbers you need to know, starting with home sales predictions. The forecasts are all over the place. Realtor.com has a conservative prediction of 4.1 million existing home sales, which is just a 1.7% increase. Zillow and Compass are more moderate, predicting between 4.26 and 4.3 million sales, which is about 4% growth. Bright MLS is more aggressive, calling for a 9% jump to 4.5 million sales. Then, you have the National Association of Realtors, which is the most optimistic, predicting a massive 14% surge. Who's right? The truth is probably somewhere in the middle. Most experts agree, this is a reset year, not a rebound year. Now for home prices. Zillow expects national home values to grow just 1.2% in 2026. When you adjust for inflation, that's basically flat. The big story here is regional. 22 major cities are expected to see price drops, mostly in the southeast and the west. These are many of the pandemic boomtowns in Florida, Texas, and Arizona that overheated between 2020 and 2022. They're now cooling off as inventory surges. On the other hand, 78 cities will see modest gains of around 4%. The real game changer remains mortgage rates. As of December 2025, the 30-year fixed rate was at 6.22%. For 2026, most forecasts see rates staying in the 6 to 6.3% range all year. Fannie Mae is a bit more optimistic, saying we could see 5.9% by year. The realistic view is that rates will stay above 6% for all of 2026. Those 3% rates from 2020 and 2021, they are not coming back. And here's the catch. If we do get lower rates, it might be because the economy is weaker, not stronger. That's the stagflation trap. After years of buyers fighting over scraps, inventory is finally improving. This is where the shift feels most real. Realtor.com expects existing home inventory to be up almost 9% in 2026, with new single-family homes growing over 3%. More choices mean fewer bidding wars and more negotiating power for buyers. But here's where it gets regional. We're seeing a great geographic divide. The Northeast still has tight inventory and limited supply, but the South and West are seeing inventory expand rapidly. This means days on market can vary wildly depending on where you are. Some markets are still a seller's paradise, while others now clearly favor buyers. This brings us to affordability, the critical factor. For the first time since the Great Recession, incomes are growing faster than home prices. This is a real improvement. The median household now spends about 27.2% of their income on a typical rent, which is the lowest it has been since August of 2021. But even with income growth outpacing home price growth, it's still not enough for most Gen Z and young families. Here is the reality check. The share of first-time buyers in the market has hit an all-time low of just 21%. The normal level is 40%. Young families are being forced into non-traditional living situations, like getting roommates, moving back in with parents, or just delaying homeownership altogether. The market is improving, but it's happening very, very slowly. So, who actually wins in 2026? Let's break it down. For buyers, the good news is there's more inventory, less competition in many markets, and actual negotiating power is returning. Seller concessions and rate buydowns are becoming common again. The challenge is, rates are still above 6%, prices aren't crashing, and affordability is still stretched, especially for entry-level homes. The upper-end market, over 750K, is actually doing better. The buyer's strategy for 2026 is to focus on markets with growing inventory, like in the South and West, and look for those cities where prices are dropping. Negotiate hard, because sellers are more flexible now. And be patient, this market favors preparedness over speed. For sellers, the reality is that low-supply markets are still commanding strong prices. But if you're in a more balanced market, you need a strategy. You have to focus on staging, pricing correctly, and being open to concessions. We are seeing more motivated sellers returning to the market due to life events and rising equity for investors. This is where it gets interesting. Build-to-rent opportunities are growing. Single-family rentals are projected to be up 2.3%, while multifamily rents are seeing very low growth at just 0.3%. These regional differences are creating some great arbitrage opportunities. But a word of caution for investors. Higher insurance premiums are eating into margins, and you have to watch out for regional policy changes. You must balance rental demand against these rising costs. And finally, for renters, this is the best news of 2026. Rents are expected to drop 1% nationwide, with even bigger drops in the South and West. Nearly 3 in 5 renters are now choosing to keep renting. Not because they're forced to, but because it makes sense for them. The big exception here is New York City, where rents are actually accelerating. Beyond the numbers, 2026 is bringing massive technological shifts that are reshaping real estate. The AI revolution is here. For home searchers, generative AI is helping buyers find homes based on their lifestyle, not just a location. You can use conversational search to find niche features like a meditation room, a cold plunge pool, or advanced air filtration systems. For agents, AI tools are predicting the perfect time to connect with clients and automating the entire process. The home features in demand are also changing. 2026 buyers are prioritizing energy efficiency, like zero energy-ready homes, solar panels, and whole home batteries. They're looking for grocery-optimized homes with walk-in pantries and extra refrigeration. Wellness features and smart home integration are becoming standard. We're also seeing industry structural changes, with the NAR stepping back from rulemaking, allowing local MLSs to take more control and innovate faster. Finally, let's touch on some major events and political factors. The FIFA World Cup in 2026, hosted by the USA, Canada, and Mexico, will bring a massive infrastructure investment and a tourism boom to host cities, creating potential short-term rental opportunities. The Senate midterm elections could shift housing policy, with a focus on affordability and yes in my backyard policies. The G20 summit in the US will influence economic policy and international investment. And we have to keep an eye on policy wildcards like tariffs affecting construction costs and immigration changes impacting the labor supply. So what's the bottom line for 2026? The great housing reset is real. The market is normalizing after years of extremes. If you've been waiting on the sidelines, 2026 offers modest but real improvements. Here's your game plan. For buyers, get pre-approved now. Research high inventory markets, negotiate confidently, and don't wait for perfect conditions that may never come. For sellers, price strategically, stage professionally, consider concessions, and understand your local market. For investors, focus on build-to-rent, target regional opportunities, and calculate the full cost. For renters, take advantage of improved affordability. 2026 won't be easy, but it's more balanced than we've seen in years. The key is to stay informed, stay strategic, and make decisions based on your situation, not the headlines. Thanks for watching, and don't forget to subscribe for more updates.